What do you call it when the market defies all logic? That's coming up on 3 Minutes on Markets and Money. Yesterday, the Federal Reserve announced that, yes, they're hiking 75 basis points as expected. The big news yesterday, of course, that sent stocks rallying was that not only are they going to remove forward guidance, but also gave the hint that they will potentially slow the rate of increases over time. Now, that's logic, right? I mean, logically, they can't keep hiking interest rates at 75 basis points indefinitely, so the rate will have to slow eventually. That's logical. But what the market took it as is that means the Fed's ready to pivot and go back to the Fed we all know and love, which is zero interest rates, QE, being market supportive. And on that news, the NASDAQ rallied nearly 4% yesterday, S&P up sharply. What do you call a market that's rallying that sharply that seems to be in a bear market? Well, that's what we call the pain trade. Investors are so short equities in terms of being underweight equities in their portfolio. Fund managers, very underweight equities in their portfolio. We've talked about portfolio allocations in terms of professional managers at very low levels. Consumer sentiment on stocks, extremely negative, very bearish sentiment in the markets. Bearish sentiment to the levels of where we normally see market bottoms. That has provided the fuel here necessary for a rally higher, as the fear of missing out is now no longer the fear of missing out on the rally. It's the fear of missing out on the bottom should the Fed actually pivot. And stocks actually broke higher yesterday, moving above this previous resistance level. Now, this sets the markets up within this bullish trend that we've been establishing from recent lows here over the last several weeks. Market continues this grind higher. As we talked about yesterday, the important test was this 50-day moving average. The market came down, tested that 50-day moving average, bounced off of it yesterday, and actually closed above the recent highs. That is as bullish of a signal as you can get for stocks in the short term, and that continues to put that underlying bid for stocks to move higher here with a target of about 4150 on the S&P index. Look, there's a lot of reasons that suggest this market's becoming more bullish in the short term, but this is a short-term trade in the markets. Longer term, we still have to deal with higher interest rates, slower economic growth, and a potential recession, and the Fed is still tightening their balance sheet, removing liquidity from the markets. So despite the fact the market is rallying like we're in a new bull market, this is still very much likely a bull trend within a bearish trend of the markets. And again, that can be very substantial. We can see this market rally 7, 10, 15%, still be within this kind of a bearish setup for the markets, have another leg down at some point later this year, early next year, as the Fed potentially makes a monetary policy mistake. But the important thing is don't mistake the fact that just because the markets are rallying, that they can't be a much stronger rally than you can expect. So again, we can take some equity positions in here, trade this bull market rally as it exists for right now, make some money with it, remove that exposure when stocks get back to extremely overbought levels, and when we start to see our money flow indicators becoming negative again, and they're not right now, that's all positive. So again, as painful as it is, this is why they call it the pain trade, is because it's painful, right? You know, if you're seeing the market rally, but you're bearish on the market, and you may be right with a view on the bear market longer term, but in the short term, markets want to make some money, and that's what's happening. Today after the bell, we've got Apple and Amazon, two big stocks, and what we've seen here lately is companies missing earnings. They're not being punished that much, or they're actually being rewarded for not having earnings as bad as estimates were expected to be. Microsoft and Google, good examples of that. Apple and Amazon may see the same type of result. Even Meta, which reported atrocious earnings after the bell yesterday, is down this morning, but again, not that much. So the markets aren't punishing stocks even for missing estimates, and that's more of that kind of bullish sentiment that I need to be in the markets right now more than I need to be out of the markets. But again, it's a tradable opportunity, not a long-term investable bottom. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you back here tomorrow.